How does a company with fewer employees than a typical Shake Shack manage more liquid assets than the GDP of Bulgaria? And how does that same company, which acts as the central bank for a $2 trillion economy, operate without a single public audit? Welcome to the paradox of Tether. On paper, it is the most boring business in the world. You give them $1, they give you a digital token called USDT, and they put your dollar in a vault. Simple. Safe. Boring. But in reality, Tether is the black hole at the center of the cryptocurrency universe. It is a $118 billion question mark that critics call the Evergrande of Crypto. For years, the financial world has stared at this entity, waiting for it to collapse, convinced that a machine printing billions of digital dollars from a Caribbean office cannot possibly be solvent. Yet, every time the market crashes, Tether survives. It defies the laws of financial gravity. But here is the thing about gravity. It is patient. And as we dig into the plumbing of the global crypto market, we find that the stability of your Bitcoin, your Ethereum, and your entire portfolio might be resting on a foundation of secrets that regulators have already proven were lies. To understand the threat, you have to understand the plumbing. In the early days of crypto, moving money was a nightmare. If you wanted to sell Bitcoin on a Japanese exchange and move it to a Korean exchange, you had to convert it to fiat currency, wire it through the international banking system, wait 3 days, and pay massive fees. It was slow and expensive. The market needed a lubricant. It needed a dollar that moved as fast as an email. Enter Tether. The premise was revolutionary in its simplicity. 1 Tether equals $1. Always. It was built to solve the liquidity problem by bypassing the banking system entirely. Traders could now jump in and out of positions instantly without ever touching a regulated bank account. It became the grease in the gears of the entire machine. Today, most Bitcoin trading is not done against actual dollars. It is done against Tether. It is the primary pair for liquidity worldwide. If you remove Tether, the volume dries up. The price discovery mechanisms break. The market freezes. But this utility came with a hidden cost. By relying on a private company to issue the world's digital dollars, the crypto market effectively outsourced its central banking to an entity that had no oversight, no capital requirements, and no obligation to tell the truth about what was actually in the vault. Why would anyone trust an offshore entity with billions of dollars based solely on a promise? Because the market was greedy. In the chaotic bull runs of the last decade, nobody cared about audit reports. They cared about leverage. They cared about speed. The people running Tether understood this perfectly. They realized that in a speculative mania, due diligence is the first casualty. They didn't need to be transparent. They just needed to be functional. This created a culture of opacity by design. If they showed their books, traditional banks might blacklist them for servicing grey market crypto exchanges. If they didn't show their books, conspiracy theorists would scream fraud. They chose the latter. They operated in the shadows, not necessarily because they were criminals, but because the traditional banking system refused to touch crypto. They were the pirates running the blockade. But when you operate in the dark long enough, you start to believe that the rules do not apply to you. You start to believe that you can redefine what a dollar actually is. By early 2017, the system was working. Bitcoin was climbing toward $20,000, and Tether was printing tokens to fuel the rally. But then the real world struck back. American banks, pressured by regulators concerned about money laundering, severed their ties with Tether and its sister exchange, Bitfinex. Overnight, the company lost its ability to move fiat currency. They were a digital dollar company that could no longer touch actual dollars. In a normal industry, this is where the company files for bankruptcy. This is where the story ends. But Tether didn't fold. Instead, they did something desperate. They began moving billions of dollars through a shadow network of payment processors in Panama and Portugal, handing over customer funds to entities that were never designed to hold that kind of capital. They saved the ship, but they had just navigated directly into an iceberg. And nobody on the outside knew that the collision had already happened. Imagine the panic in the boardroom. It is 2018, the crypto market is crashing, investors are scared, and you have just realised that $850 million of your money is gone. It wasn't stolen by hackers, it was seized by authorities because you entrusted it to a shady payment processor called Crypto Capital Corp. This was the situation facing Bitfinex and Tether. They had a massive hole in their balance sheet. If they admitted the loss, a bank run would start immediately. Everyone holding USDT would rush to the exit, demanding dollars that simply were not there. The peg would break, the company would implode. So, they made a choice. They decided to hide it. Instead of declaring the loss, Bitfinex effectively dipped its hand into Tether's cookie jar. They raided the reserves backing the stablecoin to cover the exchange's losses. They moved funds from the stablecoin reserve to the exchange's operational accounts to hide the insolvency. It was a classic shell game, but for the users holding Tether, the promise of one-to-one backing had officially been broken. This is where the financial engineering gets slippery. Tether had always claimed every token was backed by traditional currency. But when the New York Attorney General finally dragged them into the light, a different picture emerged. The investigators found that for long stretches of time, Tether was not fully backed by cash. In fact, the CFTC found that during a specific period between 2016 and 2018, Tether held sufficient fiat reserves in its own accounts for only 27.6% of the days. Let me repeat that. For nearly 3/4 of the time, the full cash backing was a lie. So what was backing the token? Receivables. IOUs. They counted loans to their own sister company as reserves. It is the equivalent of me writing a note on a napkin that says, "I owe myself $1 million," and then telling the bank, "I am a millionaire." They treated an unsecured debt from an affiliated company as if it were cold, hard cash in a vault. This redefinition of the word reserve allowed them to maintain the illusion of solvency while the actual liquidity had evaporated. They were flying a plane with no fuel, gliding on the updrafts of a bull market. You have to admire the sheer audacity of it. While they were scrambling to plug an $800 million hole, they continued to issue new tokens. They continued to tweet that everything was fine. They continued to act as the bedrock of the crypto economy. This requires a specific type of corporate psychology, a belief that the end justifies the means. In their view, they were protecting the industry. If Tether collapsed, Bitcoin would crash, and millions of retail investors would be wiped out. So, in their minds, lying about the reserves was a noble act of preservation. It is the same logic used by every Ponzi schemer and every desperate bank executive in history. We just need a little more time to make it right. And amazingly, the market let them get away with it. Traders didn't care about the backing as long as the peg held. It was a collective delusion. As long as you could sell your Tether for $1 on an exchange, nobody wanted to ask too many questions about the napkin IOUs in the vault. Eventually, the law caught up. But it didn't shut them down. In 2021, the New York Attorney General settled with Tether for $18.5 million. The CFTC fined them another $41 million. In the world of high finance, this is pocket change. It is a parking ticket. Tether paid the fines without admitting wrongdoing, and the crypto world cheered. They thought the risk was over. The regulators had looked, fined them, and moved on. The narrative became, Tether is battle-tested. If the US government couldn't kill it, nothing can. But this victory created a new, more dangerous problem. Emboldened by their survival, Tether began to grow at a terrifying rate. They weren't just covering up losses anymore, they were expanding their balance sheet into the hundreds of billions. And to generate profit on that massive pile of money, they stopped holding just cash and started buying something much riskier. Something that would earn them the nickname the Evergrande of Crypto. By 2021, the bull run was back. Tether's market cap exploded from 4 billion to over 60 billion in a year. But where do you put $60 billion if you can't use major Wall Street banks? You can't just stuff it under a mattress, you have to buy assets. And this is where the story shifts from accounting tricks to systemic risk. Tether revealed that a massive chunk of its reserves, at one point nearly half, was held in commercial paper. For those who don't speak finance, commercial paper is short-term corporate debt. It is an IOU from a company saying, "Loan us cash for 90 days and we will pay you back with interest." It is usually safe provided you lend to stable companies like Apple or Coca-Cola. But here is the paradox. At its peak, Tether was reportedly one of the largest holders of commercial paper in the world. Yet, nobody on Wall Street had seen them buying it. The big trading desks at Goldman and JP Morgan, who handle all the major flows, said they rarely saw Tether in the market. So, who were they lending money to? This silence birthed a terrifying theory. If the prime brokers in New York weren't selling commercial paper to Tether, maybe they were buying it from somewhere else. Somewhere desperate for liquidity. The financial press, including the Financial Times, began to speculate that Tether was loaded up on Chinese commercial paper, specifically debt from Chinese real estate developers. At the time, Chinese property giants like Evergrande were offering high interest rates because they were starving for cash. If Tether bought this risky debt, they could earn massive yields, turning their reserve pile into a profit machine, generating billions a year. It was the perfect arbitrage. Take dollars from crypto traders at zero interest, lend it to risky Chinese developers at 10%, and pocket the difference. But this mechanism carries a fatal flaw. If the borrower defaults, the money is gone. Commercial paper is not cash. It is a bet on the solvency of a corporation. If Tether was indeed the Evergrande of crypto, a collapse in the Chinese housing market wouldn't just hurt Beijing, it would wipe out the backing of the US dollar stablecoin that underpinned the entire Bitcoin economy. When pressed on this, Tether's executives went on the defensive. They issued statement after statement denying they held Evergrande debt. They claimed their commercial paper portfolio was rated A1, the highest standard. But they refused to disclose the issuers. They wouldn't show a list. They wouldn't name a single company they were lending to. "Trust us," they said, "we are solvent." This secrecy is not normal behaviour for a fund of this size. A regulated money market fund publishes its holdings every month. You can see exactly how much Ford or Toyota debt they hold. Tether offered nothing but a pie chart with vague labels like cash and cash equivalents. This refusal to disclose details fueled the fire. It suggested they had something to hide. Were the assets illiquid? Were they bought at a discount? Were they loans to other crypto companies? The silence was deafening, and it turned Tether into a black box that everyone was forced to use, but nobody dared to open. The pressure became unsustainable. The rumours were hurting the peg. Hedge funds began shorting Tether, betting that the commercial paper revelation would be the pin that popped the bubble. Tether realised they had to move. They had to get out of the paper market before the rumours became a self-fulfilling prophecy. So, beginning in late 2021, they started a massive liquidation. They claimed to reduce their commercial paper holdings from $30 billion to zero in just over a year. They announced they were shifting everything into the safest asset on Earth, US Treasury bills. It was a race against time. They had to sell off tens of billions in private debt without crashing the market or taking a loss, all while the crypto winter of 2022 was destroying the companies around them. They claim they succeeded. They claim they are now fully liquid. But that pivot created a new, even stranger reality. Tether transformed from a shadow bank lending to corporations into one of the largest foreign holders of US government debt. This brings us to the modern era, and the strangest paradox of all. In 2022, the crypto world burned. Terra USD collapsed. Three Arrows Capital went bust. FTX, the darling of the industry, was exposed as a massive fraud. Yet Tether stood still. During the panic, investors redeemed billions of dollars of USDT. Tether paid them all. They processed $10 billion in withdrawals in a matter of weeks without breaking the peg. It was an impressive display of strength. It silenced many critics. If they were a fraud, how did they survive the bank run that killed everyone else? The answer, according to their new narrative, is that they had cleaned up their act. They replaced the mystery meat commercial paper with US treasuries. And because interest rates in the US skyrocketed to 5%, Tether suddenly became one of the most profitable companies on Earth. With $100 billion in reserves earning 5% risk-free, they were generating over $5 billion a year in pure profit. That is more profit than BlackRock, more than Nike, all generated by a skeleton crew in the Caribbean. This massive income stream changed the mechanics of the risk. Tether began to build what they call excess reserves. In 2024, they reported over $5.3 billion in surplus capital. This is money that belongs to the company, sitting on top of the money owed to customers. It acts as a buffer. If some of their assets lose value, this cushion absorbs the hit before the token holders do. Independent analysts, who have been skeptical for years, looked at the 2025 numbers and admitted that the math looks better. A recent deep dive estimated that Tether is now reasonably collateralized against a standard market crash. They are no longer running on fumes. They are running on a fortress of T-bills. But there is a catch. This fortress is still built on trust. We are still relying on attestations, not audits. An attestation is a snapshot at a specific moment in time. An audit is a deep forensic review of the entire year's activity. Tether still has not produced a full audit from a Big Four accounting firm. Why? Because a full audit would require revealing the past. It would require opening the books on the 2017 cover-up and the commercial paper mystery. And that is a door they can never open. The leadership of Tether has evolved with their balance sheet. They are no longer hiding in the shadows. Paolo Arduino, the face of the company, is everywhere. He is on Twitter, at conferences, giving interviews. They are buying gold. They are investing in Bitcoin mining. They are buying tech startups. They are acting like a sovereign wealth fund. This pivot is psychological warfare. By projecting immense strength and diversifying their investments, they are trying to make the question of their reserves irrelevant. Look at our profits, they say. Look at our Bitcoin holdings. They are trying to grow their way out of their past sins. But this hubris creates a new danger. They are now taking those massive profits and investing them in volatile assets like Bitcoin and AI ventures. They are effectively a hedge fund that issues its own currency. If their speculative bets go wrong, that capital cushion could evaporate just as quickly as it appeared. They are betting the house again, but this time, the house is worth $170 billion. So, they have the money, they have the T-bills, they have the profits. The crisis is over, right? Wrong. Because while they fixed the asset side of the balance sheet, they forgot about the liability side. Specifically, the regulatory liability. By becoming a massive holder of US debt, they have integrated themselves directly into the US financial system. They are no longer just a crypto problem. They are a US Treasury market participant. And the United States government likes to know exactly who owns its debt. Regulators are waking up to the fact that an unregulated offshore entity is acting as a major lender to the US government. And unlike a bank, Tether doesn't follow know your customer laws to the same standard. They are a blind spot in the global financial surveillance grid. And the US government does not tolerate blind spots forever. This brings us to the Evergrande comparison in its truest form. It is not about Chinese debt anymore. It is about systemic contagion. Tether has become the single most important node in the crypto ecosystem. It is the settlement layer for everything. If you are trading on Binance, Bybit, or OKX, you are likely trading against USDT. It is the liquidity provider for DeFi protocols. It is the collateral for loans. If Tether were to fail, not because they don't have the money, but because the US government freezes their assets, the result would be catastrophic. Imagine if the US dollar suddenly stopped working in the global oil market. Trade would halt. Prices would collapse. That is what a Tether freeze looks like for crypto. Central bank researchers have modelled this. They call it an informational run. Even if the assets are there, a panic triggered by a regulatory action could force a fire sale. Tether would have to dump billions of treasuries instantly. This could disrupt the traditional bond market, forcing the Fed to intervene. Tether is now so big that its failure is not just a crypto problem, it is a financial stability problem. How could this happen? It is simple. Tether is a centralized token. It has a smart contract that allows the company to freeze funds at any address. But more importantly, Tether relies on a custodian to hold its T-bills. They can't keep physical treasury bonds in a basement. They use a broker, likely a firm like Cantor Fitzgerald, as has been reported. This is the choke point. The US government does not need to raid Tether's office in the British Virgin Islands. They just need to call the custodian in New York and say, freeze the assets. In one phone call, the $100 billion backing could be locked. The tokens would still exist on the blockchain, but they would be worthless because they could no longer be redeemed. This is the nuclear option. And as geopolitical tensions rise, and as Tether is increasingly used to bypass sanctions in places like Russia or Venezuela, the incentive for the US to press that button grows. The mechanism that makes Tether safe, holding US treasuries, is also the mechanism that puts a regulatory noose around its neck. This creates a massive prisoner's dilemma for everyone in crypto. The exchanges know the risk. The market makers know the risk. Even Tether knows the risk. But nobody can stop using it. It is too convenient. It is too embedded. To switch away from Tether to a regulated stablecoin like USDC requires sacrificing liquidity and privacy. So, the industry operates in a state of willful blindness. We all agree to pretend that the regulatory hammer will never fall. We point to the excess reserves and the quarterly attestations as proof of safety, ignoring the fact that the entire operation exists at the mercy of US foreign policy. It is a game of musical chairs played with billions of dollars. Everyone thinks they will be able to get their money out into Bitcoin or fiat before the music stops. But history tells us that when a liquidity shock hits a shadow bank, the exit doors are never wide enough for everyone. So, is Tether a fraud? Probably not in the way it was in 2017. They likely have the money now. But is Tether a lie? Yes. The lie is not about the reserves. The lie is about the safety. The lie is the idea that an offshore, unregulated entity can act as the central bank for the future of finance, without eventually colliding with the state. The cracks are already forming. Europe's MiCA regulation is squeezing non-compliant stablecoins out of the EU. The US is drafting stablecoin legislation that could ban offshore issuers from the American financial system. The walls are closing in. Tether has survived the bear markets, the bank runs, and the scandals. But they have never faced a coordinated attack from the sovereigns whose currency they are counterfeiting. And when that battle starts, a fortress of T-bills won't be a shield. It will be the target. Let's play out the scenario. It is a Tuesday morning in 2026. The Department of Justice announces an indictment against Tether for facilitating sanctions evasion. The Treasury Department sanctions the smart contract addresses. The custodian freezes the T-bill accounts. What happens? First, the peg breaks. USDT trades at 90 cents, then 70, then 50. Arbitrage bots go haywire. DeFi lending protocols, which use USDT as collateral, begin mass liquidations. Billions of dollars in leverage are wiped out in minutes. Bitcoin, which relies on USDT for 60% of its trading volume, plummets as liquidity vanishes. The buy the dip crowd can't buy anything because their dry powder is stuck in frozen Tether. It is a liquidity vacuum. Prices don't just fall, they gap down. Exchanges halt withdrawals. The contagion spreads to regulated companies that held USDT on their balance sheets. It is the Lehman Brothers moment of crypto, but without a Federal Reserve to bail it out. This is the urgent threat we are talking about. It is not a question of if Tether has the money, it is a question of whether you will be able to get it when it matters. However, we must look at the data objectively. The capital analysis from late 2025 paints a nuanced picture. With 174 billion in issuance and nearly 7 billion in equity, Tether has a capital ratio of roughly 4%. For a bank, that is low. Banks usually hold 8 to 10%. But Tether isn't a bank lending out long-term mortgages. They hold short-term liquid assets. Technically, they are solvent. Under a stress test assuming a 30% drop in Bitcoin and a wave of redemptions, the model suggests they survive. They are not a house of cards anymore. They are a house of glass. Strong, rigid, capable of holding immense weight, but brittle. If you hit it with a hammer in the right spot, it doesn't bend, it shatters. The risk is no longer financial insolvency, it is operational fragility. The data suggests they can handle a market crash. It does not suggest they can handle a regulatory decapitation. This leaves you, the investor, with a choice. You can continue to use the convenient, liquid, ubiquitous lubricant that is USDT. You can trust that the geopolitical stalemate will continue, that the US government prefers a dollar-dominant crypto market, even if it is a shadow dollar, over a yuan-dominant one. There is a strong argument for that. Tether extends US dollar hegemony. Maybe they are too useful to kill. Or you can look at the history we have just unpacked. The lies about the banking partners, the cover-up of the $850 million loss, the commercial paper mystery, the lack of a real audit. You can look at that track record and ask yourself, is this where I want to park my life savings? The market is betting on survival. But the market was betting on Enron until the day it wasn't. The market was betting on FTX until the withdrawals halted. In finance, everything works until it doesn't. Tether is the perfect reflection of the crypto industry itself. Innovative, rebellious, resilient, and built on a foundation of half-truths. It solved a massive problem, moving dollars at the speed of the internet. But it created a massive risk, centralizing that power in a black box. They fixed the commercial paper, they built a capital buffer, they won the game of capitalism. But the game isn't over. The $100 billion lie isn't that they don't have the money. The lie is that they are untouchable. United Fruit didn't disappear, they just changed their name. Standard Oil was broken up, but its pieces are still the biggest companies in the world. Tether might not collapse, but it might be nationalized, regulated, or frozen into irrelevance. And if you are holding the bag when that transition happens, the excess reserves won't help you. The plumbing of the financial system is being repiped right now, and shadow banks rarely survive the renovation. We are watching the largest game of chicken in financial history. Make sure you are not standing on the tracks when the train finally arrives. Subscribe to Capital Curriculum. We are just getting started on the list of things they don't want you to know.